The year 2025 will be etched in market history as the year a global trade war triggered a major market crash. President Trump, known for his aggressive trade policies, announced sweeping import tariffs on April 2nd. These tariffs targeted a wide range of countries. A baseline 10% tariff was applied to all imports. Additional tariffs were added on top of this. China was a primary target. They were hit with a 34% tariff on top of existing tariffs. This brought the total tariff on Chinese goods to a staggering 54%. The European Union faced a 20% tariff. Vietnam and Taiwan were also significantly impacted with tariffs of 46% and 32% respectively. The Trump administration argued these tariffs were necessary to protect American jobs and reduce the trade deficit. These tariffs sent shockwaves through the global markets. Investors feared a trade war. Uncertainty loomed, the markets braced for impact. The Dow Jones Industrial Average, a key indicator of market health, experienced a pre-market plunge. Futures plummeted over 1,200 points, signaling the panic that was to come. China wasted no time in responding to the US tariffs. On April 4th, China announced retaliatory tariffs of 34% on all US goods. This was a bold move. The tariffs were set to take effect on April 10th. This quick response was seen as a way to pressure the US stock market. Other countries also signaled their intent to retaliate. The European Union, while open to negotiations, prepared countermeasures. Global leaders criticized the tariffs. They warned of a damaging trade war. The world watched anxiously as tensions escalated. The markets reacted swiftly and brutally to the escalating trade war. On April 4th, as news of China's retaliatory tariffs hit, the market went into freefall. The Dow Jones Industrial Average plummeted 1,600 points. This was one of the largest single-day drops in history. The Nasdaq Composite, heavily weighted with technology stocks, suffered a near 6% decline. This drop pushed the Nasdaq into bear market territory, officially marking the end of the bull market that had begun in 2020. The S&P 500, a broader market index, also experienced a significant decline, opening down 2.8%. The New York Stock Exchange reflected the widespread panic, with decliners outnumbering advancers by a staggering 17-1. Nearly 2,500 stocks were in the red, signaling a broad market sell-off. Fear gripped investors. The VIX, also known as the Fear Index, spiked to 39.60. This was the highest level of volatility seen since August 2024. The market crash sent shockwaves through the global economy. Economists warned of a looming recession. Bob Dahl, a well-respected market strategist, placed the chance of a recession within 12 months at 50%. This was a significant increase from his earlier prediction of 25%. JP Morgan's chief economist painted an even bleaker picture. He estimated a 60% chance of a global recession if the tariffs were fully implemented. Adding to the concerns, EY chief economist Gregory Dacko predicted stagflation. This toxic combination of slow economic growth and high inflation spelled trouble for the US economy. Dacko forecast a drag on real GDP growth and a rise in consumer price inflation. The specter of the Smoot-Hawley Tariff Act of 1930, which exacerbated the Great Depression, loomed large. Experts drew parallels between the current situation and the protectionist policies of the past, warning of the potential for history to repeat itself. The future remained uncertain, with the possibility of a prolonged economic downturn casting a shadow over the global economy.